Let's get back to the market. India has been a big underperformer. Mohammed Apabhai of Citi joins in to talk about that. Apabhai, morning. Thanks for joining in. Last time we spoke, you were calling for this correction. It's come about now. But do you see the possibility of a further breakdown in Asian markets generally and India specifically, even from here?
Yes, good morning. I think there's been pretty much no change in the view that I have on the markets. There is a correction that is ongoing. There's a couple of things that are happening. The first is that overall we think that the period of risk-off that we thought that was going to happen on a global basis still hasn't happened, but we still are waiting for it. We've been wrong-footed on that in some of the developed markets. But for the developing markets, what is happening is that the provision of additional liquidity, which is the thing that is benefiting the developed markets, is exactly the thing that is causing the emerging markets to be sold off. So what we're continuing to see is outflows out of emerging markets going into developed markets. We're seeing large flows going out of Asia ex-Japan and going into Japan. And out of all of those, I think India is part of that, with foreign investors selling only just starting to pick up.
Mohammed, good morning. The observation has been that because of various developments like the yen carry trade, etc., liquidity may still remain quite abundant, and in that context we may not get hit that hard. But you disagree with that observation? You think there are far sharper outflows coming for this market?
Yes, I think the thing is this, that the money that we've seen moving since the start of, since the Bank of Japan meeting, has predominantly gone into the bond market rather than into equity markets. So what we're seeing is actually bond yields coming lower. And in terms of equity markets, what there is a very strong correlation between the amount of liquidity that the domestic central bank can offer, given the domestic inflationary expectations, and the performance of the equity market. So if you look at Japan, where the domestic central bank is providing a lot of liquidity, in the US, the same sort of thing is happening. Those two markets are outperforming. Markets like China, Hong Kong, India, and Korea, where the domestic central bank is a lot more reticent about providing that liquidity, are actually suffering. And we don't actually think that this is going to change anytime soon. There is very much an emphasis from these investors that are coming late into the market right now to be buying quality names with a focus on liquidity, so that if they get it wrong, they can get out of the markets very quickly. And again, the markets where that is very much the case is in Japan and in the US, rather than in India or in China.
I'm just going through one of your reports, recent reports, Apabhai, and you say that given the potentially critical technical levels emerging market ETFs are trading at, there could be the potential for liquidation. Are you saying that we could embark on another leg of this downside after pausing here for a bit?
Yes, I think that is very possible. We're still looking at potentially, I think the last time we spoke I was looking for 10% downside. That was probably 10% higher than where we are right now, but we're still looking for potentially another move of around 8% to move lower. The overall central bank liquidity is being reflected quite accurately in some of these emerging markets. So we still remain quite concerned about the outlook. For India in particular, we remain concerned about the overall macro picture. Things like the growth outlook, the fiscal deficit, the trade deficit, and inflation continue to remain concerns, as well as the earnings situation. It just doesn't seem like the outlook for Indian earnings is going to be as good as some of the other markets.
While technical definitions may vary, Mohammed, would you say from what you see and sense of India right now, it's looking like it's a market that's in a bear phase, or is it just a patch of weakness because of these liquidity issues, after which the market may well go back to being a performer?
I think it will eventually go back to being a performer. I just don't think that it's going to be now or potentially for the next couple of months. I do think that long term we are in a secular upward trend, provided that the liquidity remains. The problem is this, that when there is a huge amount of liquidity being pumped into the markets and there is an attempt at reflating the developed markets that are really driving the global economy, then the markets that already have inflation will just face even higher inflation, which will force the domestic central bank into a fairly tight corner in terms of their ability to loosen policy. So for the time being, I think the outlook for India as well as the rest of Asia ex-Japan does not look very good. Even in some of the developed markets, they're starting to look fairly extended in Japan and in the US. If they also start correcting, we don't actually think that there's going to be a DM to EM reversion trade. We think that both DM and EM will sell off even more.
Just a quick word on the currency, Apabhai, and whether that's also worrying people on the margin, given India's large current account deficit. In addition to the earnings and the macro picture, is that one more reason which could be leading to India's recent underperformance?
The currency, I think, is fairly stable. I think people who are playing this trade are doing it more through the equity market than they are through the currency market. What we've seen since the BOJ meeting has been emerging market Asian bonds stable to higher. Currencies are appreciating. So, for example, the Thai baht is now at the highest level since 1997. But the place where the weakness has been seen is really in the equity market. So the thing is that if you want to be bearish on the Indian rupee, it costs you a lot of money to do that, because the carry is around 7%. So at the moment, we don't think that people are looking at the currency as the best way to play this. Now, of course, if the currency starts moving significantly, then, of course, the macro environment is not going to be supportive. But I think what you'll have to see is first the currency start to move lower before people will potentially get involved. In the short term, it seems like the most vulnerable is going to be the equity market rather than bonds or FX.
Okay, Mohammed, we'll leave it there. Thanks very much for joining in with your thoughts. That's a cautious view from Citi, saying perhaps there is the risk of liquidation in markets like India. That's a worrying observation.